Hey everyone, welcome back to Corporate Decoder, the place where we dig into the dry corporate filings so you don't have to. This time we're looking at Navitas Semiconductor's latest report, and let me tell you, it's a bit of a roller coaster. Expect some ups, some downs, and maybe a loop-de-loop or two as we try to make sense of the numbers. Wonder before we dive in, if you like getting these straight insights, subscribe and check out our Discord community. The link is in the description below. So, what's the story? Navitas designs those power chips that make your phone chargers super fast. They're all about making things smaller, more efficient, and better for the environment than old school silicon. But let's see how that's translating into dollars and cents. First up, the balance sheet. Let's see where Navitas stands financially. As of the end of March, they had about $75 million in cash and equivalents. That's down from the roughly $87 million they had at the end of the previous year, December. So they are spending cash. Their accounts receivable is around $12.4 million, lower than the $14 million from the previous quarter. This might suggest that they are collecting payments faster or just a slowdown in sales. Now, the real meat of the matter, the condensed consolidated statements of operations. The bad news is revenue is down, like really down, from $23 million to just $14 million. This is a very sizable loss in revenue. Also, loss from operations is about $25 million, but this is better than last year's $31.5 million loss. But it's not good either way. Let's check earnings per share. Their basic and diluted net loss per share is down, is negative $0.09, meaning they are not making money, but at least it's better than the previous year, which was negative $0.02. So how is the cash flow going? Net cash used in operating activities, so money they are spending, is almost $14 million, a very good number. Let's look at stockholders' equity. Balance at December 31, 2024 was $348 million. Net loss over the past 3 months ate into the amount significantly. The next report is expected to get better, but it is not looking great right now. Now, about what's backing this, cash and cash equivalents is just over $75 million. So Navitas is holding okay. Moving on from the financials, let's talk about what Navitas actually does. The company is all about designing, developing, and marketing next-gen power semiconductors like gallium nitride or GaN and silicon carbide or CC chips. They're used in everything from phone chargers to electric vehicles, and this filing emphasizes that execution of an at-the-market agreement that the company may offer and sell shares of its Class A common stock. This means that they might dilute the value of your shares if you own some already. There are no real important recent accounting policies, but they are enhanced disclosures of costs and expenses, improvements to income tax disclosures, improvements to reportable segment disclosures. Accounts receivable is not looking too bad. This means they are pretty efficient at collecting debt. As for inventories, it's sitting at about $16 million. This is a healthy number, not very high or very low. Their property, plant, and equipment net are mostly computers and other equipment construction in progress. The total comes in at $14.7 million. They provide more details on the fair value measurements of their financial liabilities, specifically something called an earn-out liability. It is not very important. Now, about goodwill and intangible assets, it's about $163 million, meaning they may not be using all their assets appropriately. The company operates mainly through operating leases, mostly for commercial buildings. They are trying to use ongoing expedients from ASC 842. Total maturities of lease liabilities in this period is $7.5 million. The total stock-based compensation expense that they had to pay to employees and employers is almost $7 million. Not a good sign for the revenue they brought it, so it makes the loss much bigger. There is an earn-out liability that is measured at the end of each reporting period. Now, for risk, a majority of Navitas' revenues are attributable to sales of the company's products to distributors of electronic components. For this report, distributor A and B are over 10%. Also, they have the following revenue sources: Hong Kong at 59% and rest of Asia at 18%. A combined total of 77% of revenue comes from the Hong Kong and rest of Asia. Very scary risk. At 18%, a combined total of 77% of revenue comes from the Hong Kong and rest of Asia. Very scary risk. Their commitments and contingencies comes mostly from purchase obligations for equipment, which is in a release and license agreement. In terms of legal proceedings and contingencies, Navitas isn't currently facing any major lawsuits that are expected to impact their financial statements. There is an equity investment with a related party. The investment began in 22 with a $1.5 million investment with another $1 million investment the next year. They have no unrecognized tax benefits for the period. Navitas is restructuring by reducing headcount to increase their focus on artificial intelligence data centers, EV, and mobile applications. It is expected to be over by March, but there may be some more charges. Finally, they reviewed events happening after March 31, but before the report was issued, and there was nothing out of the ordinary. So that was a lot of numbers, but what does it all mean? Navitas is facing a tough market right now. Revenue is way down, and they are spending more cash than they are making. They are trying to cut costs and focus on where they think the future is: artificial intelligence, electric vehicles, and mobile devices. If those sectors take off, Navitas could be in a good spot, but they need to weather this storm. Their reliance on a few key customers in China and on a single supplier for some important components is a big risk. Anything that disrupts those relationships could really hurt them. I'm not seeing the path to profitability because it is depending a lot on a highly competitive market that many other companies are focusing on. So that's a big weakness in my opinion. Alright, that's our breakdown of Navitas' latest filing. What's your take on these numbers? Do you think they can turn things around, or are they heading for more trouble? Drop your thoughts in the comments. Hitting that like button really helps, and subscribe for more deep dives. Check out the Discord in the description for even more discussion. Thanks for watching, and I will see you next time.